So, good afternoon, everybody. My name is Tobias Steinmann. I'm Director of Public Affairs, and I'm very pleased to welcome you at our crisp 30-minute webinar to share the first ever results of EPRA's Solvency II project, customized to listed real estate. Our session will provide a concise update on the improved Solvency II regulation and how this could mean increased investment by insurance companies into the listed sector. Solvency II and investments in long-term equity have widely been referenced over recent years as a potential game changer also for listed real estate. Hence, the results of this exciting question will be very interesting and presented by experts from Milliman, a leading, if not the leading, consultancy in this area, advising the majority of the world's top insurers. On the agenda, I'm taking the liberty to kick off with a summary of the key regulatory improvements of Solvency II, which took several years to achieve them, but it will only take a few minutes to present them to you. Followed then by Job Prinz, who is a principal at Milliman, providing the filet piece of our project with key insights on long-term equity and the implications for listed real estate. And it will be Serkan Erol, who is Investor Outreach Manager at EPRA, who will round up our session with the next steps following this project and how EPRA will use these insights gathered to engage with the insurance world for more investment, hopefully. On the housekeeping, this webinar is recorded. A copy will be put on our website afterwards. You can raise questions at any time during the webinar via the respective window. In case we will have enough time, it will be covered already in the next 30 minutes. In case not, we will get back to you bilaterally. Next to that option, you can also always raise questions afterwards via email to the team directly at info@epra.com. So let's start with the presentations. One of the biggest obstacles to European insurers investing more in listed real estate companies are the heavy capital requirements imposed by Solvency II. Solvency is the biggest piece of regulation of the insurance sector. It's a 2,000-page legal file. It's designed to ensure that insurance companies can meet their obligations in the event of major losses. The rules fix the amount of capital they must hold against their investments for regulatory purposes. These rules are called capital requirements, and these solvency capital requirements are tailored to the specific risks linked to an asset class, allowing an optimal or, well, sometimes not so optimal allocation of capital across the European Union. In 2016, the EU Solvency II rules became fully applicable, and the capital risk required for listed real estate has been 39%, which was along with equities. And that's severely contrasted with the only 25% for direct property investments due to the lower perceived risk or volatility of physical bricks and mortar. So this was the starting point where EPRA's insurance members highlighted to us that solvency plays an important role in the insurance sector's underweight allocation to listed real estate compared with other forms of real estate investment. And they would like to invest more, but it's just difficult. Hence, EPRA's policy team started to advocate towards the European institutions to cut this burden from around the industry's neck. So what is the issue at stake? The insurance industry is the biggest investor pot in Europe with an astonishing 10 trillion under their wings. If the equity capital requirement of these 39% goes down, it could unlock hundreds of billions in capital from the insurance sector. And even the friction of that would be extremely positive for listed real estate in Europe. So what was EPRA's role and involvement here? EPRA's Public and Policy Affairs has lobbied for the reduction of that equity capital requirement, arguing that the impact of stock volatility on the performance of listed real estate was, well, ironed out over time, and that it offered a similar risk profile to unlisted property. And in 2019, a milestone was achieved with the introduction of a new submodule for long-term equity investment, under which also listed real estate would fall. In that new article, it reduced the capital requirement from that burdensome 39% for overall equities to only 22% for long-term investment in equities, making the new submodule lower and basically even more attractive than the capital requirements for direct property. This was a change in European legislation EPRA successfully advocated for, alongside, of course, the European Insurance Trade Association, and after in-depth interaction with EIOPA and which is the European Insurance and Occupational Pensions Authority, the European regulator, and the European Commission. However, our insurance member companies made us aware that the revisions also introduced a number of unworkable criteria that needed to be met by the insurers in order to benefit from that new risk charge. And the biggest constraints were represented by conditions to hold the investment for too long, as well as a challenging organizational portfolio requirements, like something like a ring fencing. So that was the two difficult conditions. That's why our insurance member said we will probably not apply it. So when the review of the Solvency II directive started, then a year later, EPRA again applied a multi-layered advocacy effort with regulators and institutions to improve now that achieved module. Module was there, but the conditions were not good. And again, we were pleased to see that our call to improve the conditions of that new article had been reflected in the final agreements of the Solvency II directive. There's a new article that has been integrated into European law. It's the Article 105. A on long-term equity investments. It was added into the directive and explicitly reflecting two improvements our sector and members were in favor of. I summarized them very quickly. The first one is the softening of the portfolio setup, which was before it was required to be identified, managed, and organized separately from the other activities of the undertaking. And now it needs, well, only to be identified and managed separately. So the word organized was deleted from the text. It's a small, but it's a crucial change, moving away from what was considered by insurance companies as a burdensome ring fencing. That is the first requirement that was improved. And the second one was the softening of the holding period conditions, which required that before, and I'm quoting now the text, is the average holding period of equity investment in the subset exceeds 5 years. So that was the sentence. And now the sentence says it now requires only a corporate policy which reflects the undertaking's commitment to hold the overall exposure to equity for an average 5 years. So it's a fine line of difference, which we believe, and also other stakeholders in this town believe can mean a significant change. So what is the impact and the next step? What does this mean for our sector? Both of the latest improvements could be a game changer that the insurance as well as the listed real estate sector has been waiting for. Europe's insurance industry is the largest single pool of institutional capital in this continent. A preferential treatment of certain assets compared to others can have outstanding consequences for capital markets. And EPRA has been working hard to achieve these legal improvement. And since then, we have been collaborating with our colleagues from the EPRA Investor Outreach team to execute an awareness-raising campaign over the coming months among insurance investors to give that improvement the best start possible. And for this, we wanted to quantify the impact of that new submodule and to get clear guidance how to convince insurance companies to make use of the improved legislation. And for this, we have been lucky to collaborate with one of the best consultancies in Europe, if not beyond on this matter. And I'm happy to have Job here with us, who will guide us now through the insights they have been founding. Job, the floor is yours.
Perfect. Thank you very much for the introduction, Tobias. So my name is Job Prins. I'm a principal at Milliman. And today we'd like to take you through our project we did for EPRA on the long-term equity module, specifically for listed real estate. So as Tobias already mentioned, there are some changes upcoming in the Solvency II regulation. And from these Solvency II regulation changes, we wanted to quantify two main objectives in this project. The first one is that we wanted to identify for which type of insurance companies this opportunity is most attractive. And second, we wanted to size the opportunity for the insurance in scope of Solvency II. In order to do so, we looked at 4 different angles. So the first one is on the regulatory context. So that is simply what does the new regulation say and how should we interpret that as an independent consultant. Second, we looked at the risk-return characteristics of listed real estate and compared that to other asset categories. Third, we looked at the process of investment decisions at insurance companies and identifies the most relevant stakeholders for EPRA. And as last one, we tried to quantify the opportunity at stake by showing for which insurance companies this is most relevant and how many assets would then could become interested to listed real estate. So to start off with the regulatory context, I think Tobias already mentioned most of the important requirements, but let me just summarize them quickly again. So first of all, the current capital requirement for listed real estate would be 39%. That is without taking the symmetric adjustment into account. And by applying the long-term equity module, this capital requirement would be almost halved and would be 22%. Well, this long-term equity module can be applied to listed real estate, but it also is applicable to broader other equity type investments. So there are two main changes in the LTE module. The first one is on the ring fencing that is alleviated. The second one is on the holding period, which used to be on average 5 years. And that is now changed in the regulation that you need to have a policy in place that you're committed to hold these exposures by on average 5 years. Here we believe that one important aspect here will be that you're able to show that you don't have to do forced sales in your portfolio in times of stressed market conditions. Well, these are, of course, the opportunity drivers of listed real estate in relation to the long-term equity treatment, but nothing comes as a free lunch. So there's also some things that will not be applicable anymore when you apply the long-term equity module. And the first one is that there's no symmetric adjustment. So in the current capital requirement, there is the 39% that is a base. And on top of that, you have a symmetric adjustment that accounts for current market developments and adjust the capital requirement accordingly. And that symmetric adjustment generally mitigates the Solvency II ratio volatility. Well, the second one I think is probably the most important. Listed real estate is one of the main characteristics is that it's liquid. And by actually committing to on average 5-year holding period, this asset class will become less liquid. Then there is a third item that is more on the implementation side. So in order to apply for the long-term equity module, you need to incorporate this into your policies. You also need to get approval from the regulator, and you need to implement it in your reporting. So these are certain implementation efforts you have to take as an insurance companies in order to have the long-term equity treatment in place. And then the last one, just to mention it, because I think that is the main competitor of listed real estate, that is by investing in direct real estate, which now currently has a 25% capital charge, that there is a recalibration upcoming in 2030. And as part of that recalibration, it could be that the shock associated with direct real estate might become lower. Well, this is something that is really more further in the future. The implementation time for the long-term equity model is expected by the beginning of 2027. So moving on to the second angle, that is on the comparison of excess return versus required capital. Here we have looked at typical ALM type of assumptions on expected returns versus capital charges. And for the expected returns, we used information from, amongst others, JP Morgan and BlackRock. And what you see here in the picture is that on the current regulation, that listed real estate is quite far right in the picture. But if we apply the long-term equity model, then we see that we have a similar return profile, but that the gross SCR goes down from 39% to 22%. And actually then listed real estate becomes quite comparable to direct real estate. It should be noted here that this is all based on gross SCR. So these are not net SCR effects that take diversification into account. If that is the case, then it depends on your portfolio. The picture will look a little bit different, but in high level, it is similar to what you're currently seeing for the gross SCR numbers. A second thing to mention here is that we have now only applied here the long-term equity module to listed real estate, but this could also be applied to the other equity type investments. But for now, we have assumed here that those are not affected by the LTE module. Well, then as a third one, we looked at the typical investment cycle at insurance companies, mainly to show to EPRA how this process looks at insurance companies. And so what we typically see here is that there is a risk appetite that is set by the board on entity level. And associated with that risk appetite, there's also certain investment beliefs and objectives on how the asset portfolio should look like. And then generally we see a investment cycle where you frequently monitor the exposures, you report on the exposures, and you also consider new type of investments that could be part of the asset portfolio. There, I think the main driver for new investments would be as part of the ALM study, where a new asset class will be advised to take into account in the ALM study to see how that relates to other assets and whether you want to increase exposure to certain asset categories. I think for the new asset class procedure, we see generally that there is a start from a long list of different asset classes that are in scope based on the risk return profile of those assets, but also other aspects related to, for instance, ESG. That long list will be translated into a short list, and based on that short list, it can then enter into the ALM study. So I think this gives a little bit more an idea on how the investment cycle looks like. We've also looked at the different stakeholders that are relevant for EPRA to consider at an insurance company. And there we see that it's mainly on the investment side that those are the people you would have to talk to at insurance companies. So that could be the chief investment officer or the CFO. Those are typically the people that are involved in these type of investment decisions. And depending on the size of the company, you also might enter at managerial level, for instance, on a manager of a balance sheet management department or somebody in charge of the ALM study. Well, as a last step in the process, we looked at the size of the opportunity and tried to quantify how many assets under management could come in scope of this long-term equity treatment for listed real estate. And to do that, we try to look at a approach where to see for which type of insurance companies this opportunity is most attractive. And so first of all, we believe that it is most attractive for standard formula companies relating to PIM in relation to PIM companies, because in the end, this capital requirement applies to standard formula companies. If you have an internal model, you cannot apply this LT model directly. We do believe that also for internal model insurance companies, you could use part of this regulation, or at least the ideas behind the regulation, also in an internal model context. Well, second, we believe that it is mostly relevant for insurance companies that have longer type liabilities, because you have to commit on the asset side also to, on average, a 5-year holding period for listed real estate. You want to invest in those assets to back your liabilities that are also with a longer duration. And we typically see that more the life or the pension insurance companies have those type of liabilities. So that's why we excluded the non-life companies from the opportunity here. Again, I think the same holds as with PIM versus a standard formula. We believe that it could also be applicable for non-life insurance companies, but probably less relevant for the ones that have the longer term liabilities. Well, and then the third one is that they have to be sufficiently large as a company to introduce the long-term equity module. I think in the end, it does take an investment on the insurance company side to implement it into processes, into policies, to have your reporting in place, and also to manage this as a certain mandate. And we believe that starting from a certain size, this will become attractive. And the threshold we took here is around 10 billion in assets under management. And then as the last one, it should really focus on the insurance company's own risk asset portfolio. And so there's in insurance companies also products that are unit linked, where the investment return directly flows to the policyholder. Well, for those assets or products, this long-term equity is less relevant, because in the end, it really depends on whether you have a own risk asset, whether you can have the capital benefit associated with the long-term equity module. Well, if we look at what that means in terms of the size of the opportunity, then I think we have seen that we have around 10 trillion in assets under management of insurance companies in scope of Solvency II. If we apply the filters that we indicated on the left, then we see that around 8 trillion of assets under management are then filtered out, which leaves around 2.3 trillion in assets under management, which could become attractive to an insurance company. Well, if we look at those assets, we believe that around 5% could be attributed to listed real estate, given that also from other investment considerations, for instance, relating to liquidity, you would not want to have a too large exposure towards listed real estate. So that's why we took the 5% threshold. And then we ended up with a total upper bound of around 100 billion. So we believe there is definitely a large opportunity for listed real estate, given the upcoming changes in the long-term equity treatment. So then I'll hand it over to you, Seikra.
Thank you, Job. So what's next? Well, on May 7th, Milliman presented a summary of the conclusions on this opportunity. So similar to what Job has just done here, to a select group of insurance companies. So the objective was to get the group's view on the investment universe, the project ambition, and ultimately alignment to move forward with deliverable 2. So this feedback was very positive. And so now we're shifting gears. We're moving more from insight into action with a focused outreach plan, and we're doing it in 2 steps. So step 1, which is actually already underway. So we're reaching out to the top 50 target group. So these are composite and life insurers in France, Germany, Italy, Denmark, the Netherlands, and Belgium. So these are companies that Milliman have identified as presenting a clear opportunity. And as you will have just seen, together they manage around 2.3 trillion euros worth of assets. Also, we're very targeted in who we're approaching. So Milliman have recommended that we connect directly with CFOs, CIOs, CROs, and AML functions, which is what we're doing. We understand that these are the decision makers who can actually move the needle. Step 2 is about the optionality for internal model calibrations. So this actually wasn't originally anticipated, and it came out of the deliverable 1 call, which we were obviously very pleased to hear. So some of the larger insurance companies provided this feedback. So we'll be exploring that track too, and this represents around 2.4 trillion euros in AUM as well. So at the same time, we're keeping the conversation open. So we're setting up a feedback loop into the association for interested parties. And we're also expanding our engagement to include property companies, asset managers, insurance associations, because ultimately we understand that this impacts the entire real estate investment ecosystem. So this broader stakeholder engagement will also help explain our upcoming deliverables. So deliverable 2, which is presenting the business case to insurers, is almost finalized. So we're actually in the process of reviewing it with Milliman. It's extremely detailed, extremely comprehensive. And then deliverable 3, which is the implementation plan. So this is going to be finalized around early August. And this essentially provides a practical and concrete plan for insurers to implement the long-term equity for listed real estate. We're also going to be supporting this with PR campaigns and shared materials to help inform and align the different parts of the market. So ultimately, this is all about better integrating listed real estate into the broader equity toolkit under Solvency II. And to close, if you've taken time to join today's call, there's a good chance that this may be relevant for you. So you may be a property company who has insurers as a shareholder. You may also be an asset manager who has underlying insurance clients or prospective clients. So if any of this resonates with you, we're really glad that we would like to support you. So whether it's materials, a joint meeting together, or just a deeper discussion, we're here. So please do not hesitate to reach out. And ideally, let's work together to turn this opportunity into something concrete. So this could help your stakeholders, but also for the larger growth of the sector. And I'd really like to thank you for your time, and I will hand the floor back to Tobias.
Yeah, thank you, Serkan. Thank you, Job. That was fantastic. I think great insights. And we have also a question here coming in, or more of than one. Is there a way that insurance companies can also hold American listed real estate, or does it only apply to European equities?
Yeah, so in the current regulation, it was only applicable to EAA countries, but now under the new regulation, it will be extended to OECD countries.
Yes, indeed. So it has been broadened. That is one of the improvements here as well.
And Tobias, if I may just add on that.
Sure.
So what's important to note on the opportunity set for the 100 billion that's been estimated is this obviously would then cover the global listed real estate universe. So it's important to consider that, especially when we consider the different, let's say, markets of US, in Europe, and in Asia.
Okay. And then, yeah, there's also another question when this will become applicable. So basically, it was published in the official journal in January this year and became via that European Union law. Now member states have 2 years of time to transpose it into national law, which means by the latest in January 2027, this has to become well implemented and possible made all across the European Union, but also we anticipate that certain countries are quicker than others and already make that possible in the year of 2026. Okay, so I think we're coming to an end here. Thank you very much for joining. Brief and concise. I hope you liked it. Let us know in case so or in case not. And yeah, looking forward to stay in touch, and thanks for joining. Bye bye.